Welcome, everybody, and thanks for attending our first session of our financial tax planning and public benefits webinar series. I'm John Elfin. I'm an advisor with Sunflower Hill, an original board member, and a parent of a special needs son, Jake, who's a resident at Sunflower Hill at Irby Ranch. For those of you who aren't familiar with Sunflower Hill, I wanted to give you a quick overview of who we are. Sunflower Hill is a nonprofit organization that started in 2012 by a group of parents, including myself, led by our founder, Susan Houghton. Our mission is to create places and spaces where adults with IDD live, work, learn, and thrive as a part of the greater community. We currently have a community at Irby Ranch in Pleasanton that houses about 30 residents. And we're really excited because we have 3 other communities in the works, one at Grace Point in Dublin, another Francis Ranch in Dublin, and Sunflower Hill in Lafayette. All 3 of those communities are several years or even more away from coming to fruition, but we're really excited about those. At Irby Ranch in Pleasanton and Sunflower Hill Garden, we offer activities for our residents and non-residents alike. For example, we offer cooking classes, yoga and fitness classes, Friday Night Live, holiday gatherings, and many other activities, just to name a few. So tonight, I just want to talk about our webinar. We have 3 of them coming up, but just to kind of set up tonight. I retired earlier this year, but before that, I was a financial advisor that focused on families with special needs children. And I was probably like a lot of you tonight. As I mentioned, I have a special needs son, and all the things that you worry about, is there enough money for him to live on, figuring out public benefits, special needs trusts, trustees, successor trustees, taxes, how does charitable planning fit in? I worried about all those things tonight, all those things as well. So fortunately, tonight we have 2 great presenters. The first one I'll talk about is Ellen Cookman. And Ellen is the principal of Cookman Law in Palo Alto. I've known Ellen for more than a decade. We presented many times together. And not only is she an expert on estate planning and special needs issues like special needs trusts, trustees, and the like, but she's also an expert on public benefits. I use her webinars and newsletters to keep educated myself. And beyond being a subject matter expert, she's also super personable, and just a good person as well. Additionally, we have Dan Cutter, and Dan and I kind of stayed in the same circles. He's a financial advisor with Merrill Lynch. He's been a financial advisor for over 26 years, also with a focus on special needs planning. He has 4 children. He graduated from USF. He's also an expert. He co-authored a book on special needs trusts, and his firm is made the Forbes Best in State Wealth Management. So before I hand it off to both Ellen and Dan, I just want to mention the way we're going to handle questions tonight is to answer them at the end. And you should see a button on the bottom of your screen under Q&A. You can just type in your questions there. And towards the end, I'll just look at those questions and answer them, and both Dan and Ellen can answer them from that. So without further ado, I'm going to hand it off to Ellen and Dan.
All right, thank you so much. What a lovely introduction, and I am a big fan of Sunflower Hill, so it's really an honor to be speaking to everybody here. So, as John mentioned, it's going to be Dan and I today, but we also have Sarah here. She's going to be joining a little bit later on in the webinar series, but she's also a fabulous estate planning attorney. So we're going to be talking about special needs planning and how that fits into our lives and other things. So as John mentioned, I'm an estate planning attorney and I specialize in special needs planning. So this is what I do. I don't do litigation or family law. I love serving the special needs community, and I have an older son who has high functioning autism and a younger son who's neurotypical. They're 13 and 11. And I can hear them in the background arguing a little bit. so welcome to preteens, right? Then we also have Dan, as John had mentioned, and he does an amazing job with financial advising and financial projections. And he's going to really do a deep dive in the second seminar. But you got mostly me tonight. So what we want to talk about first, when we're talking about special needs planning, it's within the context of estate planning. Okay, so just about everybody in California needs an estate plan to protect themselves from probate, protect their assets from probate. Probate is a court system that's really expensive and time consuming. It's public. And so to avoid it, you set up a revocable living trust. And my guess is probably a lot of you have set that up on this call, which is great. Along with the revocable living trust, you also do what's called a pour over will, which is kind of a cleanup document that says everything should go into the trust, just in case you forget to put something in the trust. And Dan's gonna touch on funding the trust in just a little bit. Then you also need a durable power of attorney. So this is so somebody else can sign financial documents on your behalf or pay your invoices or call the utility company for you. And by the way, if you are age 18 and up, whether you're neurotypical or have special needs and you're not conserved, you need a durable power of attorney, and you also need an advanced healthcare directive. Everybody needs that. So the healthcare directive is if you're sick and in the hospital, then somebody else can talk to the doctors, access your medical records, do all of those good things. So this is the foundation, this is the backbone that just about everybody needs. So then I want to show you kind of how do things flow? How does this go? So the revocable trust that we're talking about is at the top, this kind of dark green box. And typically, this is like from a married couple's perspective. It looks a little bit different if you're single, but things go from the family trust. And when the first person dies, the first person of the couple, everything goes typically to a survivor's trust. Now, sometimes you might have a split into an A trust and a B trust. Usually we don't need that nowadays in most situations. Sometimes you need it for control. I have a YouTube channel, by the way, and one of my videos is called "Should I Simplify My Trust?" And so just about all the topics that we're talking about here, you can find a video on it. It's kind of like Elizabeth Warren, when she was running for president, she's like, I have a bill for that. I have a video for that. So then after the second death, after the survivor dies, things go to the kids, all right? And here, this would kind of be my family, right? My younger son, he may not need a special needs trust, so it could go outright to him, or it could go into something called a dynasty trust for him. And then my special needs son, it would go to a special needs trust for him, right? So usually the kids don't inherit anything until you're both gone. Then we also have retirement accounts which pass outside of the trust. Now, one note that I want to make is that when you have your revocable trust and your power of attorney set up, if you have a child with special needs, it's important to specify that even if you're alive but you're sick or upon your death, we want your child to be taken care of as well, not just you. So you need to put in language in your trust and in the power of attorney to say, hey, money in this trust can be used to pay for things for my disabled child as well. That's how you make sure if something happens to you, your child can still be supported. So here comes Dan. He's going to talk about funding a trust.
All righty. Thank you, Ellen. Appreciate it. And so a lot of people, when it comes to you establish a trust, you meet with the estate planning attorney, and, it's a lot of work. Sometimes it could take months, right, to get everything done, and even longer if you've got a complicated estate, right? So the main thing is when the rubber starts to hit the road is after you've created the trust, you have to make sure to fund it. And essentially there's really like two ways to fund it. First one sort of by the title, and the second one is by a beneficiary designation. And so what I mean by title, it means essentially you've got your bank accounts and your investment accounts, right? And maybe they're an individual name or they're in joint name, right? That's the title of those trusts, or the title of those accounts. So if you set up a trust and something happens to you, but you don't actually fund the trust by changing the title at those firms, then your trust didn't really do anything for you, right? Because you didn't fund it. So the key is you got to make sure to fund it. And it's not just the, the bank accounts. You also want to talk about another way to fund a trust could be through a beneficiary designation. So things like insurance, 401ks, IRAs, those pass outside of your estate plan. And those pass based off of what's called a designation, a beneficiary designation. And so as you can see on the next slide here that Ellen's showing, when you're funding the trust, make sure to retitle it into the trust name for the checking account and the savings account and your investment brokerage account, your real estate deed. You got to make sure to put that in trust name as well, right? But then when it comes to life insurance, the retirement accounts, you want to make sure that you put the right beneficiary, because if you put the wrong beneficiary information and your trust says one thing and your life insurance or your IRA says another thing, it's not going based off what the trust says. It's going based off what the IRA and the retirement plans say. So mismatched designations is probably one of the biggest things we see, because you might have had an account 20, 30 years ago at a company that was in a 401k and you never consolidated those. Maybe something's happened. Maybe you've gotten a divorce and your ex-wife is listed as the beneficiary. Things happen in life, things change. So one of the most important things as you're going along into estate planning, as Ellen's probably going to talk about too, is updating that estate plan. And it's something you want to look at, very often. So make sure to, change those and fund the trust with all those different accounts. And, the personal property, you just transfer an assignment of interest on that.
Excellent. Okay, so that's really the foundational information that everybody needs. But now we're going to address specifically, what if you have a child with special needs? What does that look like? Well, for us parents who have kids with special needs, we all have kind of the same goals, honestly, regardless of your child's disability or their abilities, right? So really, we want to maximize their quality of life. That's number one. We want them to be as happy as possible. We want them to be as independent as possible, but we also want them to be protected from financial predators, right? If they're receiving public benefits, we want to maximize those public benefits, because that can really supplement any other money that they're receiving. Can, if you have a little nest egg of money, that can be quickly depleted if they're not getting those public benefits. Really, with special needs, what we're essentially doing is we're naming surrogate parents, these financial parents, who's going to take over and do what you do, all the things that you do if you're gone, right? And I think that's what keeps us up worried at night. What'll happen if I'm not there to advocate for my child? It's been estimated that special needs parents can put in like $150,000 worth of work every year on behalf of their child that they're not paid for. Maybe you're paid a little bit from IHSS, but not very much. So it's very expensive to provide these services, but we want to make sure that our child is thriving. And finally, I may be an attorney, but I hate going to court. I always try to avoid the court system, which is painfully slow and expensive, and it's public. So don't go to court. So these are, and just about everything we're talking about tonight does not involve the court system, happily. All right. So let's talk about public benefits for a minute. And the way I think of public benefits is when your child, especially when they turn 18, and if they're not able to work and support themselves, there's two things that you really need, or you receive when you work and support yourself. You get an income stream, you get your salary, and you get health insurance. And someday our United States will figure out how to decouple our health insurance from our jobs, but we're not there yet. So if you're not able to work and support yourself because of your disability, you still need an income stream. You still need health insurance. And that's what the government is trying to provide to us. So here's my handy dandy chart. All right. So let me break this down for you. And because this is really important when we're understanding special needs trusts. When do we really need special needs trusts? And so the top, you'll see it says income stream and health insurance. So there's two different types of income streams that you can get from the government, and two different types of health insurance. And this is generally, there's a few other things out there, but this is for most people. And then at the top, we say those are needs-based. That means that the beneficiary, your child, needs them because they're poor, because they have under a certain amount of assets and income. Okay, and then the bottom one is entitlement based. That means that somebody paid into the system, so they're entitled to those. Now, the top left one, supplemental security income, that's an income stream that your child can get once they turn 18, because when they turn 18, they're an adult, which is funny if you know 18-year-olds, and your money is not attributable to them, to the child, and so all of a sudden they're poor, and so they have under the resource limit of $2,000. For SSI, you can only have up to $2,000 in your bank account. Now, there are some exempt assets, but we won't go into those today. But if you want to see them in my YouTube videos, you can. But SSI is meant to supplement any other income that you might be receiving up to about $1,200 a month. Now, if you get even $1 of SSI, you automatically qualify for Medi-Cal, which is California's version of the federal Medicaid system. And under the umbrella of Medi-Cal is IHSS, which stands for In-Home Supportive Services. And that's if you have a child who has trouble with their activities of daily living, you can be paid a salary or somebody else to take care of your child. The eligibility rules for Medi-Cal and IHSS are the same. It's under the same umbrella. So I like talking about it together. Now, Medi-Cal has kind of an interesting history of the asset limits. So the asset limit for Medi-Cal used to be the same as SSI. It was only $2,000. It was awful. And then we got some really great rules that brought it up to $130,000 in 2022, the asset limit. So it really raised it. And then it got rid of the asset limit completely. So right now, there is no asset limit for Medi-Cal. You can have a whole lot of money. Now, there's still an income limit. Income limit's the same, but you can have a lot of money and still qualify for Medi-Cal. But unfortunately, California just passed their budget in July, and they now are reimposing the resource limit. It's now $130,000 starting in January of next year. So be preparing for that. If you have a child who you thought, oh, great, we don't have to worry about their resource limit, now you do. It's unfortunate. Okay, so for the entitlement-based programs, bottom left, we have Social Security disability insurance. That's if you or I worked for a while, we paid into the system, and then we became disabled. We could get an income stream based on our work history. If you have a child who's disabled, and they became disabled before age 22, and then you retire, you get your Social Security benefits, and your child can get half of what you're receiving. It's called child disability benefits. And by the way, they often don't tell you this when you retire. So you need to talk to Social Security and say, hey, I think I qualify for this child disability benefits thing. All right. And that is guaranteed money as long as your child doesn't work too much, which is about $1,550 a month. Your child can get this income stream for life, half of what you're receiving. And then when you die, sorry to kill you off, but when you die, your child gets 3/4 of what you were receiving. So it's a really good income stream. And then after 2 years of receiving CDB benefits, your child qualifies for Medicare. All right, so you don't just have to be age 65 or older. You can also be disabled and receiving SSDI or CDB benefits, and you get Medicare. There are some kids who are what we call Medi-Medi. They get both Medi-Cal and Medicare. And there's some people who get both SSI and SSDI. So it's important to understand which type of public benefit does your child receive, because that's going to affect what type of trust they're going to need. Do we need to worry about what their asset limit is? If they receive an inheritance outright, that's going to bump them over their SSI limit. But if it goes into a special needs trust, like we're going to talk about in a little bit, that preserves their SSI. Now, one other way that I like looking at this is from the child's perspective over time. So this is the timeline of what does a child receive during their lifetime. So we start at the left. This is when the child's born, age 0. They can start getting Medi-Cal right away under a waiver program, which is basically a grant. So just about all kids in California are covered under Medi-Cal, and they can also qualify for the regional center, which does not have asset or income limits. So that's why I didn't put it on the chart, but it's for individuals with developmental disabilities. So then time goes by, your child gets older, and then they turn 18. All right, all of a sudden they become poor, right? Because they're an adult and your money is not deemed to them. So they can start receiving SSI, and they can get Medi-Cal. They can continue to get Medi-Cal, though it's under a different umbrella. Then time goes by some more, and then we say the parent retires. That's kind of the dotted line. You can see then the child can start getting CDB benefits, half of what the parent was receiving or is receiving. Then after 2 years, the child starts getting Medicare. So at this point, the child might be receiving all of these benefits, or maybe their SSI is dropped off, depending on how much CDB benefits they get. Okay, so time goes by, the parent dies, the child's CDB benefits increase to 3/4 of what the parent received, and then the child passes. Okay, so you can see this is not a static thing. People's benefits change over time, and it's important to know, where are you? Where is your child in this timeline? And what might they be entitled to that perhaps they're not receiving? All right, so with all that background, boy, that's a lot of background to be able to talk about special needs trust, but I think it's really important. So what is a special needs trust? It's basically a trust that becomes irrevocable when you put money in. So that means once money goes in, you can't change it. And it holds money for somebody who is disabled. And that person who's disabled, if they're receiving public benefits, the special needs trust, the money in the special needs trust doesn't count towards their benefits. So it could have like $2-3 million in a special needs trust, and their asset limit, their countable asset limit for SSI could remain under $2,000 because that money in the special needs trust doesn't count. So why is that? It's because the child is not able to manage the money themselves. The child doesn't have access to the money. They can't reach into the trust and pull it out. They can't revoke the trust or change it. So because the child doesn't have direct control over the money, it doesn't count as their money. So it's a really nice safety net. This allows children to receive their public benefits and to have this safety net of money set aside for anything that public benefits doesn't cover, which is usually a lot of things. Now, there's a fallacy out there that special needs trusts are really restrictive. You don't really want to set that up for your kids. You know, it can hardly pay anything. Well, there was a court case just a couple of years ago that I love. And it set this, it clarified this once and for all. It says special needs encompasses the broad range of everything a human being needs in order to live, thrive, and realize their potential in life. I mean, isn't that beautiful? Isn't that incredible? Like, that's what we want. So a special needs trust can pay for a trip to Disneyland. It can pay for fun things. As long as you're not, quickly depleting the trust for fun things and you don't have any money left over, right? If there's money for it, it can pay for it. Hobbies, just things that bring joy to that child's life. So what are the restrictions? Well, there are restrictions if the beneficiary is receiving SSI benefits. Okay, the other three, Medi-Cal, SSDI, Medicare, doesn't apply. It's only if they're receiving SSI benefits. SSI, supplemental security income, is intended to pay for somebody's shelter expenses. It used to be food, clothing, and shelter. They got rid of the clothing thing like 10 years ago, and they just eliminated the food aspect. So now they only look at shelter expenses, which we've listed out. So that's if there's a mortgage or property taxes or electricity, like things kind of utilities related to the house. It doesn't include like a cable bill or something, right? So if the special needs trust is paying for those things and somebody's getting SSI benefits, then their SSI could be reduced by about 1/3. We call that the in-kind support and maintenance deduction. Now, another rule is that the trustee should not be distributing cash directly to the beneficiary, because that could count as income and it could decrease the beneficiary's countable assets. And then some special needs trusts, people got confused, or maybe they're not experts and they put in other restrictions that just aren't necessary. In that case, they do apply, unfortunately. But those are the two big ones. You look at SSI and the trustee doesn't distribute cash. And then also the one that I had mentioned before, the beneficiary cannot act as trustee. They can't manage the money themselves. Although in most of our situations, we wouldn't want our child to manage the money anyways, all right? Okay, so there's two main types of special needs trusts out there. There's the third-party special needs trust and the first-party special needs trust. The third, and the name comes from where is the source of the funds? Where is the money coming from? So for example, if you set up a special needs trust for your child, or if I set one up for Caleb, I'm setting it up and I'm putting my own money into that trust for Caleb. I am a third party in relation to my child. So other people's money is going into Caleb's trust. It's a third party funding the trust. So it's a third party special needs trust. Compare that to a first party special needs trust where, let's say, Caleb was in a car accident and he got a litigation settlement. That's his money. He would turn around and put that into his own trust, into a first party special needs trust. So that holds his money. And if he was married, it could hold his, the spouse. It's community property issue. So, mostly what we're talking about tonight is a third party special needs trust, but it's important to know that the first party special needs trust is out there anyways. Sometimes that happens. Let's say somebody sets up an UTMA account, a Uniform Transfer to Minors Act account, and they have like $100,000 saved up for the child, and that money is to distribute to the child at age 21. That's going to interfere with the child's SSI, right? That'll bump them over their $2,000 limit. So instead, you can set up a first party special needs trust and the child can transfer their UTMA account into the first party special needs trust. And there's no, they get to keep their SSI benefits. So here's a handy dandy chart, and we will be sending out the slides. So don't feel like you need to write everything down or take pictures, but you can. So you're like, well, Ellen, you just said that there's two main types of special needs trusts. Now it says three. What just happened, right? So we're adding the pooled trust, a pooled special needs trust to the mix. So we already know third-party special needs trust, that's somebody else set it up for the child and is funding it. First-party special needs trust, that's the disabled beneficiary's own money going in there. There's two main restrictions, by the way, of a first-party special needs trust. You can only put in your money up until age 65. Once you hit 65, you're looking at a pooled trust. Also, for a first-party special needs trust, Medi-Cal wants their money back. So after the beneficiary dies, Medi-Cal can bring a reimbursement claim against any money remaining in a first-party special needs trust, or like a lien. And then after that's paid off, then the money distributes the way the special needs trust says. With a third-party special needs trust, there's no Medi-Cal reimbursement claim. So a pooled special needs trust, what is that? That's basically when you have a lot of smaller special needs trusts that are kind of pooled together and a nonprofit organization runs this. So they have a master agreement and people join it with a joinder agreement. So basically, you have like a financial advisor and a case manager that are managing many, many, many different trusts at the same time. A lot of times these are not very popular because a lot of people want to choose their own trustee. They don't want this organization to take it over. But if you have like a smaller amount of money, or as I mentioned, somebody over age 65, a pooled special needs trust could be important. All right, so let's say you have the special needs trust set up and it's operating for a while and then your child dies. What happens to it? Well, you look at the language in the special needs trust. So when you draft the special needs trust, you're actually going to spell out what happens. You think ahead. What happens when your child dies? Where does it go? And there's, a lot of, we talk about this when we're meeting with our clients, but a lot of times they're thinking, okay, maybe it goes to their siblings, or if they have any children, it goes there, or it goes to other family members. A lot of times you can name a charity. I mean, Sunflower Hill is a wonderful charity to name, right? So you can find some charities that have helped your child, yes, that have helped your child, and you can name them. You can name multiple beneficiaries. I usually recommend percentages as opposed to cash gifts because we don't know how much is going to be remaining. And if you say, you know, $100,000 off the top to such and such, and then the remainder goes this way, and there's less than $100,000, then all those other remainder people aren't going to get any money. But if you say it goes percentage wise, then everybody's going to get a little part. Okay, so I think the hardest choice to make when you're setting up a special needs trust is choosing who's going to be the successor trustee. That's really who's going to be the surrogate financial parent. The trustee's role is so important. You know, they manage the money, they choose distributions, they make sure that public benefits are not interfered with. I have a video called Trustee Roles and Responsibilities, and it's a lot of things, all right? So what do we look at when we're choosing trustees? Well, most people, and of course the parents are the initial trustees, right? But we're really thinking ahead. We're thinking, what happens when you're gone? Who's going to take over? So most of the time people come in and they're thinking, well, which family members do we have or friends who might be able to do this role? You know, they think kind of who's on the bench, right? Who can we rely on? And I usually try to discourage people from naming a family member. And that's because it's a lot of work. And you want somebody who's going to live, you know, as long as your child lives, right? And if you name somebody about your age, then they're not going to be around that much longer. You may not know your nieces and nephews so well, and they might be wanting to live their best life, right? So there's other choices out there. There are professionals, there's individuals, and there's banks and trust companies. So the individuals are called private professional fiduciaries. This is what they do. They're licensed by the state of California, and they manage trusts. And most of them do a really, really great job. I'm a big fan of private fiduciaries. Now, the main drawback of them is they're human. So that means they're going to die someday, or they'll retire, or, you know, they'll pass along their book of business somewhere else. So you usually need to have some sort of succession plan set up. Now, a bank or trust company, those can also be good options. One drawback is a lot of times they require managing at least $1 million under management, and they do charge a percentage. So sometimes it can be kind of more expensive, but you get a lot for the money. You get a lot of experience. So you know, a good thing to do is just go out and start interviewing them. See how do you charge? How do you make decisions about distributions? If my child calls, how long is it going to take for you to get back to them? What process do you have to go through for making these decisions? There's also some nonprofits out there that manage special needs trusts. I mentioned the pooled trust. And sometimes you can combine the things. You can have like a family member acting as co-trustee with a bank. So maybe you're thinking, well, Ellen, you know, this professional thing sounds pretty good, but I don't really know them. I mean, how do we know that they're going to manage things well, right? Well, we need to build in some oversight. But before I talk about that, let me just mention, we do want to coordinate with other professionals, right? We have, as we're drafting all of this, we have our attorney involved, the CPA who does different things. Attorneys, we deal with 5 different types of taxes, but income taxes is not one of that. That's the CPA. And then the financial advisor like Dan, okay? So we all work together. So, okay, so I was mentioning about the professionals and that we want some oversight, right? The nice thing about, as I mentioned at the beginning, the nice thing about what we're talking about tonight, using trusts, is there's no court oversight. The drawback, though, is there's no court oversight. So if something goes wrong with the special needs trust, there's no judge looking over everything every year to catch it if there's some embezzlement or something going on. So instead, you can name typically a family member as trust protector, or you can also name a group of people an advisory committee. Now, I don't see advisory committees as frequently nowadays, just because it can be a bit more of a hassle. You name like 4 or 5 people who meet up regularly, and they advise the trustee on what to do. And Dan and Sarah, do you guys see advisory committees being set up fairly regularly, or is that not quite as much now?
You want to start, Dan?
Sure.
Yeah.
Yeah. So I think it's across the board for us. You know, a lot of times it's the family. If they have multiple members in the family and they all want to be involved at some point in time, then it gives everybody a chance to have a voice. And so I've seen it work for that. But a lot of times people are setting up, either the trust protector or the committee for like 20 years down the road or longer, right? So that might not come to fruition, and maybe those individuals have different lives at that point in time or in different states, right? But I think that's from when we see it, it's usually in that regard when it's a larger family and people want to be involved.
There you go. Gotcha.
Yeah, I was going to say, I've seen it more where depending on the beneficiary's condition and their potential for kind of having ebbs and flows in that condition, they want members of the family or trusted individuals to be able to advise on what distributions might be appropriate. So it is absolutely something that's very unique to each situation as well. But generally, if it's not for every case either. So I think the family really needs to decide if it's something that's important to them, and based on who the beneficiary is going to be. And as Dan said, it could be, years down the road, you're really trying to plan for this.
Yeah. Excellent. That's right. Yeah, it really depends on your situation. No two families are alike. Now, I have a lot of families who really like the trust protector approach, especially if they have like a neurotypical kid and they're thinking, well, I was thinking of naming the neurotypical sibling as successor trustee because they're there. We assume they're going to get along with the kid and or our other kid. Although, if you think about in my family, right, if we named our younger son as the gatekeeper, as the successor trustee of our older son's trust, fireworks, it would just be, there'd be a lot of resentment there. It would not be good. So instead, you can name the neurotypical child as the trust protector. And basically they're overseeing the trustee. They get yearly accountings. They can access the books to see how things are being invested, and they have the power to remove and replace the trustee when needed. So I think this can be very helpful. We try to set it up where they don't have a fiduciary duty, which means they're not like liable for actions that the trustee takes. They're just keeping an eye out. Okay, so that's usually a lot more doable for a busy family member who's raising their own kids, maybe in a different state. They just have their own life, but they still want to check in on their loved one.
And Ellen, can I jump in there too? So for
Please,
the trust protector, so sometimes, like she mentioned, is, you have someone who wants to be involved and, they're serving in that capacity. And so what's their level of involvement? So oftentimes what we'll recommend, if they want to be involved a little bit, at least with the financial side, is to get on a review with the client, with the trustee and the financial advisor, right? Because your advisor should be meeting with you at least yearly, right? So if they want to have a little bit more information coming from the people that they're working with, as opposed from the trustee, this will be a good opportunity for them to, sit down and have a conversation and review the assets and everything as well.
Yes, I love it. I love it. And that really ties into this, like coordinating with the professionals, right? That's when a financial advisor can really step in and make sure that everything's managed properly. Thank you, Dan. All right, now one thing that I think is super important to write that's not part of the trust document is called a memo of intent. This is basically, dear successor trustee, here's everything I want you to know about my child that my child can't express themselves perhaps, right? So what makes them happy or sad? What do they really enjoy doing? Do they make a trip to Disneyland every year? Do they have certain hobbies? How do you want the money spent? What really ticks them off? What allergies do they have? What extended family members do you want them to hang out with? Which people do you not want them to hang out with? So you can spell all of that out. And this is something you can update every 3 to 5 years, but it's super important because it's kind of like a brain dump. It's like you're letting the successor trustee know everything that you've learned about your child over their lifetime, right? So it's a lot of information, but successor trustees, I can promise you, they love these memos of intent because you're really getting them up to speed on your child. They don't have to guess, like what is your child like or not, and your child may not make the best decisions. So, we want you to really be able to continue the goals that you've had for your child and keep that going. Now, one word I'd like to share about the structure of your trust. So remember, we were talking about setting up the revocable trust at the very beginning. And upon the second death, or if you're single on your death, goes to the special needs trust. Well, there's two main ways that we see out there that this is set up. One way is you have a revocable trust, and embedded within that trust is the special needs trust language. We call it a testamentary special needs trust because it basically springs into being when you die. That's the testament part, all right? The other option is you can set up your revocable trust, and you also set up a standalone special needs trust. So that's a special needs trust that's created at the same time as the revocable trust. Now, I think the standalone special needs trust is by far superior for two main reasons. One of them is that anyone can give money or leave a bequest to a standalone special needs trust at any time. As I mentioned with the testamentary, with the springing special needs trust, it's only effective when you're gone. So if you have a grandma who wants to leave money to your child, but you're still alive, there's no special needs trust to leave money into. But if you have a standalone special needs trust, it can accept money from a lot of different places at any time. But even the more compelling reason, I think, to set up a standalone special needs trust is because what happens is when you die and the special needs trust is funded, the Social Security Administration wants to see a copy of the trust. So they require you to send in a copy so they can review it and make sure it's a valid special needs trust. And if they get this trust and they see this big, long revocable trust, and you say, well, see Article 6, it's in there. They don't know how to read trusts. They have no idea what's going on. And I've actually heard from attorneys that they make them cut and paste the terms of the special needs trust because maybe the trustee succession is in Article 3, but the alternate distribution is in Article 10, and so it's all spread out all over the place. It's really confusing. So you just want to make it as easy as possible when you're dealing with public benefits. They're vastly underpaid, understaffed, undertrained. Make it easy for them. So I think a standalone special needs trust is the way to go.
And I have a question for you, Ellen, on that really quickly. So if you're creating the special needs trust, the standalone special needs trust, what would you say about funding that? How would you do that?
So usually it's an empty trust. It's kind of waiting in the wings. We say it has $10 in it. So the structure is created. But this is something, Dan, I'm glad you bring this up because you do need to inform people it's not there to be funded yet. I mean, if you are your child's special needs trust, right? You're providing everything that they need. There's no reason for you to put your money into a separate special needs trust, and then you have to file separate tax returns, get a separate tax ID number, and then transfer it out. You just do it yourself. This is really a substitute for you when you're gone. So usually I recommend not getting the tax ID number until you really need it. Because I worry that the IRS is going to come back and say, hey, you got a tax ID number. Where's my tax return? Come on. Now, sometimes you're required to get a tax ID number for different reasons, but usually I say hold off until you're ready to fund that special needs trust. And usually that's at the parent's death, or if grandma wants to leave $100,000 into that, that's a good time to fund it as well. All right. So you guys are in luck because we have a case study that Dan is going to walk us through. So please.
Awesome. Thank you. Well, now that we all know everything about government benefits and special needs trust and estate planning, I'm sure you guys will get ready right for this. No problem. So we just wanted to bring a little levity, right? In webinars, I know you guys are sitting here for a while and, want to make something that's a little bit comedic in it. And so I like this show called Parks and Recs. So hopefully some of you other folks out there would like it. That was one of the shows I used to watch with my kids when they were a little bit younger, and they actually understood, adult humor. So it was kind of fun. So this is what we call the Wyatt Nope case study. This is a family. So this is what we're going to have going for the next couple sessions, right? This is a three session presentations. And so we'll sort of be going back to the case study about Leslie Knope and Ben Wyatt. So essentially, the background is, as we all know, for those who don't know, I'll go into a little bit of detail, but Leslie Knope and Ben Wyatt were living in Pawnee, Indiana, okay? And Leslie's got two kids. They've got two kids already. She's pregnant right now. She's the director of the Pawnee Department of Parks and Rec, and Ben is the former boy mayor, and he's turned the state auditor and has become expert in municipal turnaround strategies, and they're married. And so Ben has an old story where he was legendary story. When he was 18, he became a mayor of a town, a small town, and he, really, he did a really bad job. And basically, in 2 months, he got kicked out of the job for trying to create what they call an ice town, essentially. So it's a pretty funny little bit. But Ben essentially, hey, he's a tech guy, and he's really good at software and budgeting, and he's an auditor. So in this situation, in this scenario, he ended up, people licensed his software, and they ended up getting a good settlement out of it. So it's kind of like a Bay Area person who might get a settlement from an estate, right, or from their firm. So the Nopes and the Nope Wyatt team, essentially, they've got $10 million now, and that is broken down into, he received a big payout from this. It's broken down into having a nice house in Palo Alto, cabin in Lake Tahoe. They've got retirement accounts and investment accounts. And as members of a community in Indiana, they looked around and saw that, Indiana doesn't have a lot of resources. And so they said, hey, where is there other opportunities to get good resources? And so they found out about the state of California and our regional center system. And so in this case study, they moved here and now are living in California. And they have done a good job of, developing some of the, wealth that they've gotten from previous. But then it comes to a situation where, their third child was born and the third child had Down syndrome. And so because of that is why they moved to California. And that was the initial motivation for them. And so now, fast forward 15 years later, or about 20 years later, their son Danny is still living with them, right? He's in a community day program, and he participates in a lot of different sports and so forth. And, so some of the questions are, what do we do now? Right. And as Ellen said before, right, so some of the things we need to look at is, how do we set up that trust? Do we do the trust for the individual family first and set up that special needs trust as a standalone? And the thing about trusts is, there's three players in a trust, right? You've got the grantor, you've got the trustee, and you've got the beneficiary. So if you create your own revocable living trust, you're the grantor, you're the trustee, and you're the beneficiary, right? A special needs trust is different. The grantor is usually you, hopefully you as a third party or someone else and not a first party, right? So hopefully someone else is the grantor. You have could be a family member, could be a professional trustee, or an institution, could be the trustee. Then you have the beneficiary, which is the person with a disability. And, as Ellen mentioned before, having a sibling holding the purse strings over another sibling isn't always the best thing for family dynamic relationships, right? And so even if they're doing the right thing, right, they may not make a distribution because the law says you can't do it or the rules say you can't do it. And so the other person might not know that as well. And so that could sour the relationship. So we, in our practice too, we love professional fiduciaries. Our team, we started about 20 years ago. My partner and I founded the team. We're about 20 people right now. So we're more of like a boutique team inside of Merrill Lynch. And we work with probably 300 fiduciaries in California alone. And so we see the good ones, how they work and what they do. And they're much better than an institution. I wouldn't even recommend my own institution, right? Because they have the more compassionate caregiving, and the trustee is focused on the administration of the trust. They're not really focused on the person side, the healthcare and things like that. But usually professional trustees are going to do a little bit more than an institution would in that regard. So that's another reason why we tend to like them a little bit more. So, in terms of the overall, situation with the case study is, we've got the family, they're essentially, they went to the internet and they found these awesome YouTube videos by a woman named Ellen Cookman. I think that was her name, right? If you look on YouTube, you could probably find a few of them. I would Google her name, guys, and you guys can get those right there. They're awesome. But that's what most people do, right? That's what the Nopes did, is they Googled it and they found someone. And as Ellen mentioned, this is not just an individual situation, right? She's not the only person involved. There's other professionals that are involved as well. And so when you get a team and the team dynamic, that's really great at helping shepherd the individual through the rest of their life, especially if you're no longer there, right? Because oftentimes, you're taking care of the child up until you maybe get a little bit too old to do everything, right? But, when you're gone, someone else has to do that. And with the memorandum of intent and all the things that Ellen was talking about before, it gives you the resources and the tools, and you have all these different players that are here to help in that regard. So, serving as the trustee, again, we really like the professionals and or a nonprofit, maybe that could do a much better job. And, if they want to serve in, then being the trust protector, as Ellen and Sarah said before, is a really good role for them to feel like they're still involved in the process, right? Because the biggest fear, we all have is, when I'm gone, who's going to take care of, my people, my loved ones, right? And if it's a stranger, that's kind of weird and awkward. It just doesn't feel right. But if you develop a relationship with someone and you have someone else involved that you trust to hire people, then that makes it a very, it makes the odds of, being more productive a lot greater. So I know we're at an hour for this presentation, and we've got about 7 minutes till till the end. And so I wanted to check first, yeah, if anyone else wanted to say anything else before we go to Q&A. Is there anything else, Sarah, that you want to say, or Ellen?
No, this is great. And as Dan mentioned, we're going to build on this case study over the next couple of times. So, so this one is really to demonstrate, like, okay, this family, they need a revocable trust, right? They probably need a special needs trust for Danny. Thinking about who's going to be the successor trustee. How are the two neurotypical siblings going to be involved? So this is just to kind of stimulate some thoughts. But yeah, I'd love to open things up to some questions, but I actually just have a couple of other slides. So this is our firm, Cookman Law, and we're here in Palo Alto. We're completely virtual, and we serve people all over California, but we do meet with people in person as well in Palo Alto. And then this is Dan's team. Look at these lovely people. They're in California, and they have offices other places too. I didn't know that. Super cool. And then here's how to connect with us. So we have my information on the middle left and Dan's. As I mentioned, if you missed, I have a YouTube channel. Please like and subscribe. And we also have some. I know at least I'm on social media. So is Dan. And then if you want to, scan these codes to be added to a monthly mailing list or set up a time, we welcome that. So maybe, John, now we can open things up to question and answer. Is that good?
Yeah, let's do that. And great presentation, guys. Really appreciate it. So we do have a bunch of questions, so let me get into it. So first question, we have a special needs trust. Does this mean that we should change the name of our joint checking that we use every day, or should it be in the name of the trust?
So I can take this one. So the special needs trust actually doesn't get funded until you're gone, typically. So if you have a special needs trust that's kind of empty and just sitting there, then it's just waiting in the wings. It's waiting to be funded. There's no reason to put your stuff into that special needs trust right now. There's no reason to retitle anything. And in fact, if you do put things into the special needs trust, you'll have to file a Form 709. It would be considered a gift. So no, just use your joint checking account as is, and just make sure that in your estate plan says when you're gone, a certain percentage or, whatever you have in your revocable trust goes to that special needs trust. That's how things get funded when you die.
Got it. And this is a similar question. So what does it mean to retitle an account? I have a trust. Do I need to ask the bank to update the account name to reflect the trust?
Dan, you want to take that?
Yeah, yeah, definitely. So, well, I guess one question I would ask you to, Ellen, I'll get into for a second, but if you want it in your estate plan and in your trust, you can also name it into your checking account and have it as the trust name as your checking account. And so some banks and institutions, what's the minimum amount in order for an estate for the a probate? Is it 100 and
It just went up. It's about, Sarah, I don't know if you know the exact, it's like $208,000.
I'm gonna say I round to 208.
okay?
Yeah, it used to be 184,500. I could barely remember that number. Now they're giving me a new number to remember.
Right.
So exactly.
It keeps
So go ahead,
changing,
Dan.
right?
Yeah.
Yeah. So you can have, as long as the checking account is in your individual name, if it's under that amount, you really don't have to worry. But if you're someone who has, a couple different accounts and some CDs and some other things like that, you want to make sure to put those into the trust name, because you don't want that balance getting into something in the place where you have to do, a probate for it.
Okay. When we have like maybe 5 more questions, so we may just go a few minutes over. Um, the money my son will get due to my husband's retirement, would that go into a first party special needs trust?
Ah, such a good question. That's a great question. All right. So when you have a retirement account, you want to name beneficiaries, and you can typically name a third-party special needs trust as the beneficiary of a 401k or an IRA. Now, if your husband's getting a pension, or like if he gets a CalSTRS pension or UCSF or something like that, they each have different rules as to whether you could name a trust as the beneficiary. So you kind of have to look into that and see, can I name my child? So you typically want to name a third-party special needs trust, not a first-party one, in that situation. Anything to add?
I think
No?
that's
Okay,
great. I
great.
think that's great. So next question. If the trustee can't give out cash, how does my son get what he needs to pay for?
Right. Well, so you can give them like a debit card or a credit card with a limit, maybe a $500 spending limit, and then the trust can pay off that card. I know here in Palo Alto where I am, there's some restaurants and stuff that don't take cash anymore. So you pay by card, right? So if your child's able to do that, then you can give them, there's also a card called a TrueLink card that you can pre-program what your child can spend money on. So that's a really nice way of making sure if they go to, if they drive and they get some gas at the gas station, that they're also not picking up cigarettes and alcohol, but they're just, maybe getting candy. So you can program what they can get.
Okay, great. Now, this next question is a CalFresh question. Do we feel comfortable answering a CalFresh question, or should we pass on this one?
Well, I mean, I'm looking over the question from the anonymous attendee, and I'd like to kind of address the idea that if you start receiving more SSDI, your SSI goes down. And that's true. SSI is intended to supplement anything that you're already receiving. So if you get more earned income, or if you get more SSDI, then the government figures you don't need as much SSI. And so that'll go away. And that's just the way it works. And I agree, it does kind of, we're not dealing with a lot of money, especially living in California. It's really hard to make ends meet with public benefits. And that's why, figuring out a way to fund a special needs trust, whether it's through life insurance or through other ways, I think can be so important.
Okay, great. So next person's is really asking for fiduciary recommendations. I'm not sure really that we can do that specifically unless maybe they
If
reach out.
you, yeah, reach out to my office. I have a list of people that I like. Dan, do you also have a list?
Yeah. We're a lot of them every region, so feel free to reach out.
Yeah. Okay. So Ellen, you're saying that not to open a special needs bank account to save money due to needing tax ID. So if my son has tapped at CalAble, where else can I save money for them monthly? I don't know if maybe Dan, you want to maybe answer that, or or anybody?
Yeah, you know, you don't want to put it in their name, right, and have it get over that $2,000 amount, especially if they're on SSI, right? So there's not a lot of places to put it if you've already got CalAble, you know, maxed out, other than the special needs trust, right? Where if it's your money or if it's a parent's money or someone else's money, right, it's a lot easier to do that. But usually, you know, what I tell a lot of people sometimes is if you know that's the money that you're going to, if you have multiple children or something like that, and that's money you know that's going to be going into special needs trust, you can almost open up another account and just call it the special needs trust money, kind of, even though it's not the special needs trust, it's still your trust. That way, at least it gives you the mental accounting that that's the money that you're going to be using to fund the special needs trust, you know, when you pass away, because life happens and life changes, you know, and, you know, it's really hard. Rules and laws change, right? Before you didn't put a beneficiary for a special needs trust in an IRA or 401k. You know, the Secure Act changed that a few years ago. So, you know, this is something that when you make a decision, you're always going to have to go back every, you know, few years to look at how everything is set up, because life happens, one, laws change and rules change.
I would add to a couple of things on this note also. One, there are potential tax benefits to you providing for your child directly. So for example, if you're worried about using a gift and estate tax exemption amounts, by paying for medical care, for example, medical expenses directly as an individual and your child, you're not utilizing that up. Whereas if you're putting money directly into a special needs trust, creating it now, or giving money, which you don't want to do directly to your child, you're utilizing up some of that exemption. So there's some more tax efficient ways also to support your child. And then two, you know, to really think about your power of attorney. Ellen mentioned, you know, those documents earlier in the presentation. And so if you are going to house this money still under your name, you do want to think about the scenario where you're incapacitated, and you want to be very clear in those documents that your agent has authority to benefit, you know, that child or all of your kids, whatever that looks like. But your attorney may need to add some special provision in there just to make sure that you can use money from that's, again, still housed under your name and your revocable living trust, or you as an individual, that that money can be used if you're incapacitated to support your child as well.
Right, thanks, Sarah. So if we open up a standalone special needs trust in California and move to a different state, can we transfer the trust to the new state?
Yeah, I mean, the challenge here is that every state is different. You know, even in our case study, they moved from Indiana to California. What would happen there, right? So you'll want to consult with an attorney in the new state and show them the trust and let them look it over and see what do they think. As California, we have very different rules than most other states, and they're actually much more beneficial than most states. I had one case where we set up a special needs trust for somebody in California, and she moved to Texas. And it turns out that some of the language that we used in the California Special Needs Trust would have invalidated that language in Texas. So we just don't know what the rules might be in a different state. So you need to have another attorney look at that trust and see if anything needs to be amended. Anything to others to join?
Yeah, I think you have some reasonable reliance that, at least as far as federal benefits are concerned, a California trust is drafted both with federal benefits in mind, like social SSI, for example, and California benefits. But as Ellen noted, Medi-Cal in particular, it has a lot more flexibility than Medicaid programs in other states. So that's the program in particular where you'd want to have an attorney in another state kind of look for to make sure there's no disruption there. And that's where, you know, the trust protector that Ellen spoke of earlier, you know, that person may have some ability to make even though this trust is irrevocable potentially, can make an amendment there to comply with even state law, and that might be permissible. But again, you'd want to consult that attorney in the other state.
Okay, great. So do you recommend having a successor trustee participate in regional center meetings before they become the actual liaison or the actual successor trustee, aka before we die?
I think that's a hard call to make because we just don't know if I mean, when you're setting up a successor trustee, you may not pass away for 20 more years. So you don't know if they're going to be acting in this role or not. So you can pull them in. But again, I think having that memo of intent is super important, to talk about, what you've dealt with the regional center, and see how much that successor trustee might want to get involved. The more that you can pull them in, I think that's good, but a lot of times they're very busy, and they really don't have a role to play until they step up and act. So it's an interesting question.
What?
Yeah,
and I
and there's
think that,
also, oh, go ahead, Dan.
good. I was going to say that I think that part of the question too is developing that relationship, right? So if it's something where you're maybe a little bit older and that you're going to need some more help here within a few years or so, I think trying to bring someone in to educate them on your child and who they are and what they like. You do have the memorandum of intent to look at, to share, but also, some people might just not like, maybe someone wanted a female and someone wanted a male, it doesn't matter, you just never know what the relationship's going to be like. So sometimes it's good to test that out in advance, because you just don't ever know what's going to happen in the end.
There's also a part of the question here. It says, I was shocked to recently learn that unless I name my successor as a co-conservator now, that essentially everything I set up would not occur. I don't know if trustee and conservators are different. They don't necessarily have to be the same thing. I don't know if that was intended in the question or not. So they don't, a trustee and conservator, they don't have to be the same person. They can be different things. So I don't know if we want to differentiate there or not. But anyway, okay.
Yeah, I mean,
I
I
want
was
to.
gonna say the conservator could also be conservative of the person and conservative of the estate, right? There's different sides to it as well, and so it could be the same person, it could be different people, just as long as everyone's working together.
And in fact, that's the next question. Is it okay to have a co-conservator as the trustee, or is it better to have them as somebody else? I don't know if somebody wants to address that question. Has an
I think if you
opinion.
have one trusted person, go ahead and name them for both roles. I think that the conservator role is more about their person, right? Where they're living, what education are they getting, their healthcare needs. So whoever who's going to be the best for that. And usually a conservator is a family member. Usually it's not the professional, okay? And sometimes that person is also good with money. They have all the talents, right? But if there's someone else who you think is much better with managing money and overseeing the financial advisor and all of that, then you might prefer to segregate those roles.
Yeah. Okay. Is there a limit to the individual contributions to a special needs trust, and will the contributions be taxed?
Boy, you can put a ton of money in a special needs trust. It's awesome. But what Sarah was talking about earlier is that any contribution to a special needs trust, you have to report as a gift. It doesn't qualify for the annual exclusion amount of now $19,000 is going to go up to $20,000 next year. So it eats away dollar for dollar at your estate tax exemption. So in that way, it's taxed. I mean, I imagine like a bean counter at the IRS where you're filing your Form 709s to let them know how much you've given away, and then once you get to next year, it's going to be $15 million per person. All right. So once you've given away $15 million and they go, aha, now we can tax you at 40%. Right. So really, there isn't really any tax, but there's a reporting requirement until you get to a really, really, really high number. So that's the way I like looking at it.
Yeah, and then also consider, a special needs trust is an irrevocable trust. So for income tax purposes, it does become its own entity. And while the creators, the settlers are alive, there's some opportunity there to have it be a grantor trust. There's things like that you can kind of play with the income tax ramifications. But when both creators of this trust are deceased, and so oftentimes, these, like we've talked about, these are funded on death, this is its own tax entity, and the IRS does give you some benefits. They know it's a special needs trust, so there's some consideration for that. But that's something to think about as well, that, you know, this is potentially not only has gift and estate ramifications, but also some income tax ramifications. You don't get to not stop paying income taxes on the money you put in here. Let's put it that way.
Okay, everybody. So what I'm going to say is we're now at 7:41. So number one, I'm going to tell you about our next two sessions. But we have a bunch more questions. So what I'm going to say is I think I'm speaking for the presenters to say that you can probably reach out to them if you want to ask them specific questions. But I want to number two say thank you for a great presentation, Ellen and Dan and Sarah too. I know you weren't presenting today, but I know you're going to be great. Our next session is on October 29th, where again, Dan and Sarah, I'm sorry, Ellen, are going to be presenting. I know we had a few questions about ABLE accounts, but we're going to talk about estimating future financial needs, how much really you need to support your special needs child, funding a special needs trust with various assets, ABLE accounts, and then coordinating between special needs trust and ABLE accounts. And then the third session, which I'm really excited about, where I think Sarah is really going to lead, is tax planning, charitable planning tools, things like federal gift and estate tax rules, donor advised funds, qualified charitable distributions, QCDs, and how they apply to special needs families. So, and that is on November 12th. So I'm guessing a lot of the people that were on this on tonight's session are going to go to those, but you can sign up at sunflowerhill.org under events. So thank you, everybody. Thanks for the presenters, and everybody have a great evening. All right.
Thanks, everyone.
Take care.
Thanks
Okay.
a lot.
Take care.